Welcome to the video. Today we will challenge the idea that buying a home is always the smartest financial move. We will look at the real costs, the opportunity cost of home equity, and when owning does make sense. To keep things practical, we will share a step-by-step decision process and a short case study. Let's begin by previewing what's ahead. Here is the agenda. First, we will establish context and define a primary residence as a consumption asset. Next, we will unpack the true cost of ownership and the opportunity cost relative to diversified market investments. Then, we will weigh stability and lifestyle control. After that, we will walk through a conservative decision framework and a case study. Finally, we will test your understanding with a quick quiz and close with key takeaways. Before we proceed, a quick disclaimer. This video is for educational purposes only and is not financial advice. Your location, taxes, and personal situation will change the numbers and conclusions. Please consult a fiduciary financial advisor before making decisions. With that in place, let us set the context. Now for the context. Many high earners face limited local investment options and the friction of moving frequently. As a result, homeownership can feel like the logical next step. However, a primary residence is not a guaranteed path to wealth. It is primarily a lifestyle purchase that provides shelter, control, and stability. With that understanding, we should avoid treating a home like a pure investment. Next, let us define exactly what we mean by a consumption asset. In this section, we frame a primary residence as a consumption asset. It provides shelter and lifestyle benefits rather than a guaranteed return. This matters because using a home as an investment proxy can lead to overspending, neglecting retirement contributions, and ignoring hidden costs that reduce returns. Even if you secure a low rate, like 3.5%, it is prudent to buy conservatively rather than stretching to a maximum pre-approval amount. Next, let us confront a popular myth head-on. The phrase that renting is burning money is misleading. Rent pays for flexibility, which can be valuable if your life or career changes. Ownership carries recurring costs, such as property taxes, maintenance, insurance, and homeowners association fees. Later, if you sell, transaction fees further reduce gains. Accounting for these expenses, the realized return on a primary residence can trail the returns of a diversified investment portfolio with daily liquidity. Now, let us quantify the ownership costs over a 10-year horizon. This table illustrates the true costs over roughly 10 years for a $450,000 property with 20% down. Mortgage interest depends heavily on rates. At a low rate, interest might be in the low hundreds of thousands over a decade. At higher rates, the interest cost rises substantially. Property taxes, maintenance, insurance, and association fees add to the burden each year. Buying and selling introduce significant transaction costs. Importantly, there is also an opportunity cost for the down payment and home equity that could have been invested in liquid markets. These are broad estimates and will vary by market, property type, and individual behavior. Next, let us visualize a practical decision tree to guide you through rent versus buy. This flowchart starts by asking whether you expect to remain in the area for at least 5 years. If not, renting and investing the difference is recommended to preserve flexibility. If yes, the next step is verifying that you have a robust emergency fund of 6 to 12 months of expenses. Without that, buying should pause. If you do have the emergency fund, check whether your total housing cost will be at or below roughly a quarter of gross income. If not, reduce the budget, often to a $400,000 to $500,000 range if relevant to your market. Next, confirm that your retirement savings are on track and that you are maximizing tax-advantaged accounts. If not, prioritize those before buying. Finally, assess job and location stability. If stability is low, renting remains sensible. If it is high, buying conservatively with a 7 to 10-year horizon is reasonable. Throughout, avoid speculation on appreciation and account for the full cost stack. On the left, renting offers flexibility, reduced responsibility for repairs, and preserves liquidity for market investments. However, renters face potential rent increases and limited control over the property. On the right, owning provides stability, control, and forced savings through principal payments. Yet, ownership comes with recurring costs and substantial fees to sell, which reduces realized returns if you must move. Therefore, the choice hinges on time horizon, stability, and opportunity cost. Here is a practical checklist. Keep total housing costs around a quarter of gross incomes. Even with an unusually low mortgage rate, resist the urge to stretch and buy conservatively. Maintain a sizable emergency fund. Maximize retirement accounts before upgrading your house budget. Model the full ownership cost stack, and then compare those outlays to renting, plus investing the difference in a diversified, liquid portfolio. Finally, only buy if you can hold for 7 to 10 years, and avoid relying on appreciation to bail out the math. Next, let us ground this with a brief case study. In this case study, a high earner who relocates frequently compares buying a $450,000 home at 3.5% with renting and investing the monthly difference. The pie chart shows a substantial share of 10-year housing dollars going to interest, taxes, maintenance, insurance, and transaction fees. Even with a low rate, those components are not recovered upon sale. Renting and investing the surplus can yield higher liquid net worth, especially if frequent moves trigger selling costs. However, the legitimate advantage of buying is stability and control. If stability is your priority and you plan a long hold, buying conservatively can be appropriate. With that foundation, let us test your understanding with a short quiz. Quiz question: what is a primary residence primarily from a financial perspective? Option 1, a consumption asset. Option 2, a guaranteed wealth creator. Option 3, a risk-free bond. Option 4, a pure tax shelter. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a consumption asset. A primary residence provides shelter and lifestyle value. Potential price appreciation is uncertain and often reduced by taxes, maintenance, insurance, and transaction costs. Now let us move to one more question about budgeting with low interest rates. Quiz question: with an unusually low 3.5% mortgage rate, what is the best approach according to our framework? Option 1, stretch to the highest pre-approval. Option 2, buy conservatively and continue prioritizing retirement savings. Option 3, defer retirement contributions to put more into the house. Option 4, assume appreciation will cover ownership costs. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to buy conservatively and continue prioritizing retirement savings. A low interest rate should not justify stretching your budget. Maintaining liquidity and maximizing retirement accounts remain the top priorities. Next, let us capture the essential takeaways. These are the key points. A home is primarily a consumption asset. Non-trivial costs reduce realized returns. Equity tied in a property carries an opportunity cost versus liquid investments. The most durable benefit of owning is stability and control, not guaranteed financial outperformance. Even at low rates, buy conservatively and keep total housing around a quarter of gross income. Above all, prioritize retirement savings. To summarize, purchase a home for stability, not speculation. If your hold period is short or your emergency fund is thin, renting is likely the better option. Always compare full ownership costs with the alternative of renting and investing the difference. Keep liquidity and retirement savings at the center of your plan. Finally, let us close with a quick call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. Share your experience and questions about renting versus owning in the comments. Your stories help others learn. See you in the next video.